Well, welcome to our Chapter 4 lecture. I am looking at the book on page 124 to 125, and this chapter is about completing the accounting cycle. Think about some of the things we've looked at in previous chapters, kind of a chapter about just information about accounting in general, and then we've also looked at the rules of debit and credit. We've looked at transactions, how to do journal entries, what's a ledger, what's a trial balance. And so we're kind of taking some of those concepts now and we're going to take them and apply them to the full accounting cycle, which is just the process we go through from beginning to end to capture all of the accounting information we need to and then turn that into a complete set of financial statements that we can then issue to users, primarily investors and creditors. So that's what this chapter is about, is kind of taking the next step to finishing the accounting cycle and what that means. And so we've got two methods of reporting. Periodic can be either fiscal or calendar. Okay, and so accountants like to stop and measure, and we like to stop and say, here's how we did this accounting period, or ultimately this year. A year can be a calendar year, which is kind of what I've been more used to in my accounting career. Every company I've worked for has been on a calendar year basis of January to December, and I've worked for 4 different companies doing accounting. Fiscal year would be USF would actually be an example of a fiscal year company. A lot of nonprofits go with a July 1 to June 30 fiscal year. So here's another example of April 1 to March 31, which is just simply 12 consecutive months. But going back to that, every business I've ever worked for doing accounting, we always stopped and did the full cycle every month. We just report year to date. Here's how we did up to this point during the year. Okay, but at a minimum, we need to do this annually, once per year. Okay, let's talk next about accrual accounting. Okay, it says here, what do we do when transactions span more than one accounting period? We use what they call the accrual method of accounting. And so this is what businesses use. And we've talked about GAAP, generally accepted accounting principles. And the whole point with GAAP is to match revenues that have been earned against expenses that have been incurred, and then match those together to get to a proper net income number for the accounting period, matching revenues earned to expenses incurred in the same accounting period, called the matching principle, which we have coming up here very soon. So accrual accounting, revenues and expenses recorded as they are earned and incurred, not necessarily when cash is received or paid. So we're focusing more on, when did I earn a revenue, when did I incur an expense, knowing the cash could happen at that same time, it could happen in the future, or possibly the cash part's already happened in the past. Okay, so this really is how we measure the performance of a company rather than cash flow. We still do a cash flow statement to help us understand sources and uses of cash, and that'll be coming up in the future. But for today, we'll focus more on the income statement. Okay, and so you can see here, every accounting period that happens, if you think of that accounting period as being a year or a month or a quarter, as a business is conducting its day-to-day operations and doing what it does, it's earning revenue, it's incurring bills, it's paying vendors. All these things are happening continuously. The point is to be able to match revenues earned in one accounting period with all the expenses incurred in that same accounting period to get an accurate measure of net income. So revenue recognition. We record revenue when 2 things happen. The earnings process is substantially complete and cash has either been collected or collection is reasonably assured. Okay, so what does it mean by substantially complete? Okay, so let's say I have a lawn mowing business, just as an example, and I've got a set of regular customers that they call me, or I schedule to say every week I'll mow your lawn in this day, or they schedule me as needed, and I get called, or we have an agreement in place that I'll mow their lawn every week. I mow their lawn, I bill them, they pay me. Okay, so as I mow their lawn, We've already agreed on that, that's acceptable. That's what they want me to do. Um, and so then they also, I've earned the revenue because I've delivered the service. It's substantially complete. Okay, so I delivered the service they asked me to do. I've earned the revenue, even if I have not yet been paid, which is part two, which is cash has either been collected or collection is reasonably assured. Okay, so I'm doing something a customer asked me to do, and I've either already been paid or I know that I will be paid. Okay, so we're not focused so much on the cash collection as we are on when did I earn the revenue by delivering the good or service the customer asked me to do. Okay, so that's one key thing to be thinking about as you look at this. When they talk about revenue recognition, they give you the same two examples from the previous screen right in the bottom of page 126. And they'll give you some more examples and explanations on the top of page 127. So next is the matching principle, which I've already kind of alluded to here. And it says all costs and expenses incurred generating revenues have to be recognized during the same reporting period as the revenues were earned. I think I've said this before, and I'll say it again, that it's impossible to, it's not possible in revenue without incurring expenses. Okay, so if we're going to earn revenues, we have to incur expenses. Okay, with all revenues, there are expenses. So the key thing is to match them together in the same accounting period. And it's challenging because, a lot of our expenses, when are we actually billed? When do I pay an expense? Think about utilities, for example. A month goes by and we're incurring utility expenses as the lights are on or as heating is being used and so on. And then when that month is over, the utility company knows how much a utility we used, if it's electricity or natural gas or water or whatever it is, and they bill us based on what we used. Okay, so I may not know in one month how much utilities I used until the next month happens. So that's where it can get challenging, and that's where we still have to think about. I'm paying this, the utilities for this month, next month, but I still have to record this month something for utility expense because I incurred them in order to earn revenues during the accounting period. Okay, so this might cut off just a little bit at the top here, but it says example, accrual basis versus cash basis of accounting. Okay, so here's an example we can look at. And the matching principle is in your book, just so you know, on the bottom of page 127 and also on page 128. So be sure you are familiar with that and understand that. So here's an example we can look at. It says here that during 2009, Bond Consulting billed a client for $48,000. On December 31 of 2009, it had received $41,000 from that client, and with the remaining $7,000 will be received in the next year, which is 2010. Total expenses during 2009 were $31,000, and $3,000 of those costs were not yet paid at December 31. So cash basis, I completely focus only on cash as it's received is called revenue, and cash as it's paid is called expense. Okay, and so my cash receipts for this customer were $41,000, and I've paid cash of $28,000. Okay, I had expenses of $31,000, and all but $3,000 were paid. So $28,000 of expenses. So under cash basis, I have net income of $13,000. But under accrual basis, we earned $48,000 by doing consulting for the client. We did all that consulting in the year 2009. Therefore, we earned the revenue in 2009. So we will record $48,000 of revenue in 2009. Okay. Then on the expenses incurred side, I incurred all those expenses in 2009. Just because I haven't paid some of them doesn't mean that they should not be expenses in the year 2009. So I record the full expenses incurred. And so my true net income for 2009 really is $17,000. So we do the accrual basis because it's much more accurate. And when I talk about accounting principles, just know that many accounting principles are geared towards the income statement and a proper and accurate measurement of net income. Okay, so the matching principle being one of those. Well, that leads us to the concept of adjusting entries. Adjusting entries are done at the end of each accounting period. Okay, and we do them to adjust accounts to their proper amounts and properly reflect revenues earned to expenses incurred in the same accounting period. Okay, and so just think about any business that you can think of, and every day a business is conducting operations. It's delivering goods and services to customers. It's paying its invoices, paying expenses, and so on. And then we get to the end of an accounting period, which could be a month or a quarter or a year, and we stop and we measure. Okay, and we stop and we go through the process of preparing financial statements. But before we can produce financial statements, we have to go through the process of making sure that all revenues earned have been recorded for the accounting period and all expenses incurred during the accounting period have been recorded. Okay, so that's what we have to be thinking about and make sure we take care of. Okay, and so that's what adjusting entries will do for us. And you can see that there's 4 types of adjusting entries. Some to record unrecorded receivables, unrecorded liabilities, something called a prepaid expense, and unearned revenue. So we'll look at each one and do some examples of each. Bottom of page 129 kind of starts the discussion about adjusting entries. And then after that, we've got specific examples on several pages. So unrecorded receivables is the first one that we'll look at, and you'll find this primarily on page 130. Okay, page 130. And here's the example. It says Precision Management earns rent revenue of $500 in 2009, but they don't expect to receive the payment on that until January of 2010. And so obviously an adjustment will be needed. Okay. Sometimes when we do an adjusting entry, we will look at the original entry and we make an adjustment to it. In this example, there is no original entry. Okay, we just know that we need to record the fact that we have a $500 rent receivable and that we've earned rent revenue. So if I'm a landlord and I've got a property that somebody's leasing from me, as they occupy the property, I earn the revenue even if the cash has not yet been paid to me. Okay, so if they occupied this property in 2009 and have yet to pay me $500, that's still revenue to me. So I can still call that revenue, even though it hasn't been paid to me. It'll be paid to me in January. So to properly record the correct amount of revenue in 2009, I have to make an adjusting entry, which is to debit receivable and credit rent revenue, both for $500. Okay, both for $500. And they'll walk you through that example or one kind of like it also then on page 130 that you can take a look at. Okay, how about unrecorded liabilities? Another example here, Protege Inc. is assessed property tax of $1,000 in 2009, but won't make the payment until January of 2010. And so we need to make an adjusting entry because that property tax assessment relates to 2009 operations. Okay, so they need to record that expense in the year 2009.
So you can use a whole jar, and if you're not happy.
So you can see the entry here. There was no original entry in this example. And so we're going to make an adjusting entry to debit the expense, debit property tax expense of $1,000, and credit a payable, a liability, property tax payable, to show that we now owe somebody $1,000. Okay, so this will make sure the expense gets recorded in the correct accounting period. Here's an example called prepaid expenses, and I should just tell you also that they walk you through a couple different examples of unrecorded liabilities, page 131 and 132, well worth your time to look at. Okay, and then let's look at prepaid expenses. Another example here, July 1, 2009, Apex Inc. pays $3,600 for a full year's of rent. Okay, so let's say they sign a lease on July 1, 2009, and it's a 12-month lease to rent a property, and they're going to write a check to the landlord for the full year, $3,600. Okay, and obviously $300 a month. Okay, and so now we get to the end of the year, December 31, 2009, and we have to make an adjusting entry. So think about how much time has happened between July 1 and December 31. Just think to yourself, okay, I've got all of July, August, September, October, November, December. That's obviously 6 months. Okay, and so I need to make sure that I account for 6 months worth of rent expense that happened between July 1 and 2009. So the original entry is down here. The original entry is we're going to debit an account called prepaid rent, and we'll credit cash. So our landlord said, I'll definitely lease this property to you, but I want a full month of rent from you, or full year's worth of rent from you in advance. And we say, that's fine, we'll do that. We debit prepaid rent, which is an asset. Remember that assets are economic resources that benefit our business in the future. And so now I've got this asset called prepaid rent that will allow me to occupy the property for the next year. Okay? But then as I occupy the property, as I use this property up, I need to record it as expense. And so I'm going to then have to make an adjusting entry to debit rent expense for $1,800, 6 months times $300 a month, and credit prepaid rent. Because every month that goes by, I incur more expense and I use up the prepaid. So prepaid goes down, rent expense goes up, and that's my adjusting entry. And they give us some very good examples involving things like rent and insurance in your book, and also supplies on pages 133 and 134. Well worth your time to look at. Okay, the next example is unearned revenues, and you can see this one in your book on pages 134 and 135. And here's another example to take a look at. July 1, 2009, Dahl Company receives $3,600 for 1 year's rent in advance, okay, covering July 1 of 2009 to June 30, 2010. On December 31, an adjusting entry is needed. Okay, so now this is the landlord. This is the landlord's perspective, and the landlord says, "Okay, tenant, before I'm going to lease to you, I want a full year's rent in advance from you." And this happens, and we make an entry when we receive the payment on July 1, 2009. We debit cash and we credit unearned rent. Okay. So this happens, just kind of just a step back. This happens for a number of reasons, and a couple of those reasons, especially in property management, are with a new business, there's no history, and so the landlord is basically saying, if you're a brand new business, the odds of you failing or not surviving are pretty good, and so to protect myself, I'll let you rent this property from me, but I want a full year's rent up front before I will do that, and that way the landlord's protected in knowing that the payment will be there every month. Okay, but we can't earn the revenue until the property has been occupied. So every month that advances, the property has been occupied and we've earned rent. Okay, so initial entry, we receive the check up front, and we'll definitely put that in the bank. We have all the rights in the world to put that money in the bank and cash the check. Okay, but we have to credit an account called unearned rent. Whenever you see the word unearned, I want you to think that's a liability. That's something we owe somebody. We now owe the tenant a year's worth of occupying the property that we're leasing to the tenant. Okay, so $3,600 for a year. Obviously, that's $300 a month. And so after 6 months, July, August, September, October, November, December, 6 months, 6 times 300 is 1,800. We can now make an entry to record the fact that we have now earned 6 months worth of revenue because the tenant has occupied the property for 6 months. So we'll credit rent revenue for 1,800 and debit unearned revenue for 1800. So we increase revenue, we decrease the liability. And so when we get to the end of the year, we've properly measured revenue in 2009. Okay, that's the purpose of doing that one. Okay, so again, make sure you read through the examples in the book. They're very good, and in addition to what I'm helping you out with here, those examples will help you tremendously. The bottom of page 136 has what they call a remember this. It's kind of a purple shading, and they just kind of walk you through the two-step analysis to make a journal entry. Step 1, determine what adjustments are necessary and ensure that all asset and liability accounts have been properly recorded. Step 2, determine which revenues or expenses must be adjusted to correspond with the changes in asset or liability. And then they give us the 4 entries that we can make, the ones we just got done walking through. And it tells us what we should be debiting and what we should be crediting to make the adjusting entry. Okay, so just a nice little summary is waiting there for us. I have showed everybody in previous WebEx meetings, and I'll show you again with the next WebEx meeting, but in the my.usf class portal under handouts, I've got a couple of files that will help you kind of go through that process of remembering adjusting entries and what they're about. And one of them is called Adjust Ref. It's a summary of adjusting entries and kind of what they're about and what accounts we should debit and credit. And the other is called Adjusting Entries Tutorial, and it's kind of this big file that came from the accountingcoach.com website. It just walks you through the process of learning adjusting entries. Kind of one of those things, if you just do it a few times, eventually you'll get this kind of burned into your memory, and you'll remember what you should be doing and kind of what adjusting entries are about. Now, some of that information may include information about depreciation and depreciation as an adjusting entry. We have not yet covered that in this chapter, so don't worry about depreciation quite yet if you see that in any of my review materials. Okay, so once we get to the end of an accounting period, we've been doing our accounting every day. We get to the end of the accounting period, we do our adjusting entries to make sure we have properly measured revenues when earned and expenses incurred in the same accounting period. Then the next step is to we get to produce financial statements. Remember that the financial statements that we're going to look at are our income statement and our balance sheet and our statement of equity. Okay, so the 4-step process using a trial balance, because the trial balance, remember, is a list of all of our accounts with their respective debit or credit balances, and of course total debits must be the same as total credits. And you can see an example of a trial balance in your book on page 139. So it says identify all the revenue and expense accounts to prepare an income statement. Compute net income. That's always the first thing we need to know, is what is net income, because net income affects retained earnings or equity, and so that will then allow us to compute retained earnings. Then finally we prepare the balance sheet using the same retained earnings number that we computed in step 3 is used for step 4. So we do financial statements in order on purpose, which is income statement first, then the statement of retained earnings, then the balance sheet. Okay, because we need a number from each one before we can move on to the next one. So they're done in order on purpose. Okay. So next is the notes to the financial statements, and they show us the financial statements. Again, I said page 139, and you'll see them also on pages 140 and 141. The next is the notes to the financial statements, and I'm not sure who bought the book that would have included Appendix A, which is the Walmart 2009 annual report. If you just happen to pull that out and look at it, as you pull it open, you'll see the beginning of it is kind of what they call management's discussion and analysis, kind of management's talk about how the company did, why the numbers were what they were, analyzing some of the numbers, comparing several years of information together and discussing the trends. So it's kind of what management writes about itself, and then once that's done, then they start to talk about the financial statements. They'll provide the financial statements which are on pages 20 and 21 of the report. And then, actually, I should say pages 18 to 21 of the report. And then they have the notes to the financial statements after that. So the rest of that annual statement is the notes. Okay, the notes include the list of assumptions and the methods used in preparing the financial statements. Keep in mind that with GAAP accounting, sometimes I have choices into which specific accounting principles I'm going to apply. There's many ways to compute depreciation. There's many ways to track inventory. So there's several accounting principles give us a choice. And so we're going to discuss which principles we're using and why we chose them. And we'll give more detail about specific items. Like in the balance sheet, we might have one line that says inventory, but then in the notes, we could have paragraphs discussing inventory. What is in our inventory? What method of accounting do we use to value our inventory? And so on. Okay, so it just gives more detail to help the user understand the financials. Next is the audit, and remember that audits are done by independent accounting firms. You know, if we think really big accounting firms that are nationwide, you can think of PricewaterhouseCoopers, Deloitte & Touche, KPMG. Regionally around Sioux Falls, you might think of Eide Bailly or McGladrey Pullen would be a couple of the more bigger regional firms with offices in Sioux Falls. And of course, you've got smaller shops too that are more just very local. But an audit is an independent CPA or a team of CPAs going to a company and verifying the accuracy of the financial statements, making sure that the numbers are accurate and that accounting principles, that our GAAP accounting principles have been applied. Okay, so they review all kinds of things, review adjusting entries, they sample transactions, they do IT audits, internal control audits to make sure that information that went into the accounting system is accurate and can be relied on when it comes out of the accounting system also. Okay, and so auditors issue a report that discusses their findings and if they do believe, yes or no, that the financial statements are accurate and can be relied on. It's called an unqualified opinion. You don't need to know that, but that's just what it's called. And so they'll just have a in a financial statement, especially one that's from a publicly traded company, they'll have a page of that financial statement will be their write-up, their findings about the company and their signature. Okay, so next let's talk about two kinds of accounts, real versus nominal accounts. This is on page 144 of your book. Real accounts are what we call permanent accounts. They're not closed. And those are your balance sheet accounts, assets, liabilities, and equity accounts. They're called real accounts or permanent accounts. They're not closed. I may use both terms interchangeably. I've taught this class from a couple of different books. This book's going to focus more on real accounts, and then the other would permanent accounts then is kind of what my other book talked about. So we'll talk maybe more real accounts with this book. Then nominal accounts are temporary accounts. Okay, so nominal or temporary kind of means the same thing. Brought to a zero balance at the end of the year. They're closed. These are your income statement accounts, which is revenues and expenses, and also your dividend account, or if it's a sole proprietorship, that would be what they call an owner withdrawal account. So income statement accounts, revenues, expenses, and dividends. Okay, these balances are not carried forward. They're literally closed at the end of the accounting period. Okay, so the closing process is very important. They show us the closing process in the book on page 145. And so there's a really good discussion on that page with some examples of closing journal entries and then the closing process that you see right here. Record closing entries that reduce all nominal accounts to a zero balance at the end of the accounting period. So remember, nominal is temporary, the revenue, expense, and dividend accounts. So revenues would have a normal credit balance, and so to close revenues you give them a debit. Expenses would have a normal debit balance, so to close them you give them a credit. Dividends would have a normal debit balance, so to close them you give them a credit. And you just transfer them directly to retained earnings, which is a real account, right? Permanent account, we never close it. And so revenues are a credit to retained earnings. because revenues make equity go up. That's why it's a credit to retained earnings. But expenses and dividends make retained earnings or equity go down. So therefore we debit retained earnings because retained earnings is an equity account. We expect it to have a credit balance, a normal credit balance. So you can see beginning balance, the additions and deductions of the postings from the closings to get down to our new ending balance. Okay, so the three-step process to close our accounts are right here. Okay, three-step process. Number one, step one, close all revenue accounts by debiting them. Step two, close all expense accounts by crediting them. Step three, the difference between revenues and expenses is net income, which should be credited to retained earnings. So you can see right here how we've done that. So we're debiting revenues, crediting all the expenses, and then whatever it takes to, and we would also include a credit to dividends also if we have dividends, and then a credit to retained earnings to make a balance. Okay, so that is our three-step process to do the closing of the books. So to step back and think about the accounting cycle, there it is right there. Step one, analyze transactions. We did that previously to this chapter where we talked about what is a transaction, what's a source document, how do I know if it's a debit or credit or if that's an increase or a decrease to an account. Step two is kind of the same thing. How does that transaction affect my accounting? What's the journal entry? How do I post that from a journal to a ledger? Step three, summarize the effects of the transactions. Do our postings from the journal to the ledger, prepare a trial balance, make sure it balances that total debits equals total credits, because if they don't, then we have a problem. Obviously, then if it doesn't balance, we have to go back and find out, the mistake that was made that it doesn't balance. Then finally, we prepare our reports. We do from the trial balance that will give us some information to be able to do the adjusting entries. Once the adjusting entries are done, we can then prepare the financial statements. Then finally, we can close the books. And after we close the books, one final thing that most companies do is prepare a post-closing trial balance. Your book has one on page 146. And that's a list of all the accounts with balances after the closing entries are posted. So once the closing entries are posted, all temporary or nominal accounts should have a zero balance. Okay, so all revenues, expenses, and dividend accounts would have a zero balance, and only the permanent or real accounts would be left over, which is your balance sheet accounts, your assets, your liabilities, and your equity accounts. Okay, so that's it for chapter 4. It's just really critical to read your chapters, and they have these kind of what I'll call these little remember this notes throughout the chapter. Great summaries of some key information. There's a really good remember this also on page 147. That'll be worth your time. And another one on page 148 where they're going to walk you through the sequence of the accounting cycle again also. So just really good things to look at to help you remember the material for chapter 4. Okay, so we'll have a WebEx about this topic also, and by all means you can ask me questions through email or save them for the WebEx. Either way, or give me a call and we can go from there. So thank you.